Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Michael Oliver. And before we talk to Michael, I want to just tell you to go to olivermsa.com, olivermsa.com, to catch up with Michael and what he's doing, and also consider subscribing to his excellent newsletter. Thanks for joining me again, Michael.
Good to be back.
Always good to have you. I have been shorting the NASDAQ by way of an ETF, namely ProShares Short QQQ, symbol PSQ. And over the past 3 weeks or so, and it has gone against me. Should I bail out and take my 9 or 10% loss now and swallow my pride and move on and get ready for the next bull market, or what's your advice?
Oh, well, NASDAQ there had to be one, I guess. You had this roar back up after the August low in most indexes and sectors. And because the NASDAQ has a hefty tech weighting, and because there's several symbols, not a multitude, several strong symbols, especially within the NASDAQ 100 that are heavily weighted, that shot up strongly, that helped get the NASDAQ up to nip its high out. Now, that is not, I don't think, indicative of a market trend. I think it is a teaser. There are plenty of times, if you go back and look at tops in markets, go back over 50, 100 years, find a monthly chart of the Dow or the S&P, you'll find quite a few times that in a topping process. Remember, October of 2007, for example, we peaked in May, had a hard drop into August, and Bernanke printed a new high for us. Took us up into October, took out the high by 1%, and everybody said, oh boy, we're off to the races, and that was the top.
Mm-hmm.
So, new highs don't impress me. Now, if it were across the board and everything, but it's not. It's extremely narrow. Most sectors are anemic at best, or had a nice sharp rally. But when I do my momentum measurements, not just looking at the price chart, but, where's price in relation to certain means, certain long-term averages and so forth, and I oscillated and created a different vista of the market as opposed to the simple price chart, this rally is squarely up against what I think is major annual momentum resistance, and I suspect the rally is either over or about over, and the confusion that now exists, namely we were all stout and strong in early August, and everybody was very weak and scared late August, and now everybody's back to, well, either they're stout and strong or they're confused as hell. And
yeah.
It's a confusing chart when you look at it, I admit that, on a price chart.
Sure.
But when I go to the momentum action, it looks exactly like it did in October of 2000, which was a strong reach-back rally after the top had already occurred in 2000. It closed on the high of the month that month, and by December, you were back pressing the lows. It happened in 2008. If you recall, when we started out 2008, we dropped 200 S&P points in a heartbeat. Double bottomed again in March, turned up in May, went all the way back up, just about unchanged on the year, beating our chest on the price charts, that is. Mm-hmm. And that was a baloney rally as well. You rolled over. By June, July, you were back at the lows. So while I don't expect this rally to evaporate immediately, I tend to expect it to run out of gas in this area, arm wrestle its way back down, and by the end of the year, you'll probably be again back into a weak stance where even a price chart observer will say, gee, it looks weak. It's happened before, in other words.
Yeah, well, again, it's your momentum work, I think, that sets you apart to a great extent, in my mind, from many of the other analysts. I don't know of anyone else who does it quite like you, and I really appreciate your work. You said recently, I think maybe it was in your weekend missive, and I quote, the resurrection of commodities and commodity-related stocks is not an if, from our perspective, only an issue of when. In the next quarter, the technical evidence will show itself. I know not all commodities, no, that's the end of your quote. What I want to say to you is that I know that not all commodities are going to move together. You've made that very clear. You can't just take, like oil maybe is going to take longer, or copper maybe is starting to move. But what are your thoughts generally speaking? You think we've seen the bottom for most of these commodities now?
I think for most of them, yes. For oil, it's a coin toss whether you again make a new low. You made a new low 2 months ago, taking out the March low, which was just above $42. We dropped to just below 38 and immediately shot back up to 50. Right now we're about 43, 44. Whether we'll go down and take out that 37.75 low we made 2 months ago, I don't know. I think it's really a short-term trader's market right now in the oil market. I think from a broad perspective, stand back and look at the big picture. It's a basing process. Sometimes basing processes, you eke out a new low here or there, but the collapse phase is over. I mean, people who are chasing oil now on the short side, I'll make you a bet they weren't chasing it last summer when they should have, when it was in the mid-90s, headed down. Now in the 40s, they want to get bearish and short. Good luck. And I think oil is to some extent, it's an outlier, is a laggard, and it keeps the tenor and tone of the commodity argument depressed. Because if oil's weak, that must mean all commodities are. We'll take a look at a sugar chart. Or take a look at the stability in the corn market, or look at gold. All these things are poised with very little further nudging to start moving up nicely. Even the cattle market, which was a late bloomer on the downside, collapsed so fully and has rebounded so sharply. I think it saw its lows. It finally joined in the commodity bear market, but I think it's already seen its low and it's now stabilized well off that low. So I think oil is really a deceptive market to watch because so many people put so much emphasis on it as if it is indicative of all commodities, and it's not.
Well, speaking of gold, one technical analyst on a show that I was on with him yesterday, he was calling for a possible decline to 600 in gold. What are the chances of that in the next 6 months or so?
I continue to hold the view that I've held for the last couple of years, and that is ever since the June 2013 collapse, it was a crash. Gold went from the 1600s, and next thing you knew, it was 1178. It did it in a matter of a few months. That's a crash. That's the way markets. Either they start that way, which gold did not. Gold peaked at 1900, and it spent the next year or so going sideways to slightly down. It wasn't until later, a year and a half or so after the top, that it actually crashed. Since then, we've had two new probes to a new low, and each is like 2% below the prior low. And right now, gold is trading where? About 0.5% below the low of June 2013. It's October of 2015. It's 2 years and several months later, and we're 0.5% lower than we were 2 years ago. Put that in. That's what you need to think about. What's going on? Somebody's buying it. Okay, now again, we're measuring it against the dollar, and the dollar's been firm. So that's the weakest view you're going to see of gold. If you measured it against the euro, the yen, you'd have a different picture.
Absolutely.
But anyway, I'm still positive on gold. My big numbers, final breakout numbers, are in the low 1200s, between 1203 and 1209, especially a monthly close. Realize that the recent high was 1191.70 a few weeks ago. So I'm not talking a lot. And I think that gold is just quietly poised below these levels, and when it's right, it's going to strike.
Well, and I guess
silver's in full agreement with that, by the way.
It is, and I think you're of the opinion when both these markets turn around to the upside, we're probably looking for a bigger gain in silver than in gold.
Yeah, I think so, and I think a bigger gain in the gold miners than gold as well.
All right, so that's music to our ears. We, of course, those of us on the long side, of course, I guess your view is that you are now, I think, correct me if I'm wrong, but you are now of the opinion that you would be 75% of the total amount of gold allocation you would have in a bull market. Once you get over that low 1200 numbers, you would be looking to go 100% of the amount you would allocate to gold, whatever that amount
whatever
is.
Whatever an investor would like to have put into gold 2 years ago to build a position, I think you should have started after the June 13 crash with 25%, and I've since added two others. One's crossing back above 1100, and the other one's back above 1150. That leaves me the 1 quarter left of additional to the position. Now, that whether you're buying gold miners or you're using futures or whatever, but in a basing process, it's best not to be super aggressive and highly leveraged. If you are, you can get whipped around pretty good.
Yeah.
Because the bases are not easy. They're not clean. They're up and down. That's what a base is. And it's only once you've broken through the final hurdle, like at the Kentucky Derby, when the gates open, whoosh, that's when you maybe put some emphasis on leverage. But right now, I think the better approach to gold is, 75% long, unleveraged. And if you want to get leveraged, then once we cross that last hurdle, then maybe consider it. But I'm speaking, for the investor who, for instance, buying gold coins or something.
Sure. Yeah. No, absolutely. Well, point well taken. Well, the dollar index is another thing you commented on this weekend. How is that looking? Because it has so much to do, as you just sort of noted, relative to the way we view gold.
Yeah, it's confusing in that the dollar index really is not revealing a lot of the truth that's out there in the Forex markets. For instance, I think the yen is at a potent bottoming process and is not far from a breakout. Now, the yen is about 13% of the dollar index. The dollar index is really, it's 56 or 57% is the euro.
Right.
So when you look at the, quote, dollar index as opposed to the dollar versus a specific currency, you're really dealing with the inverse of the euro, which means you're going against Draghi, because Draghi wants that euro down, and he knows how to play the game.
Yeah.
So the question is whether the Fed, now that they're out of ammo in terms of yields, unless they want to go negative yields, and they've been talking about that.
Yes,
at least one of the Fed spokesmen. That, and also the mention of the dollar in the recent two months worth of minutes from the Fed has been an incredible increase in the mention of the dollar as a factor compared to prior minutes over the past few years. So they're seeing the dollar now as a threat because it is, in their view, hurt our industrial markets, our industrial companies, and therefore maybe they need to play the currency game, which the Japanese and the Europeans have been doing. And, of course, I think about the only tool the Fed has to do to get involved in that game is to try to compete with Draghi. Draghi's talking negative rates. Now, maybe we want to do that. In which case, that you could get some weakness in the dollar index because of its relation to the euro. But forgetting the euro issue, when you look just at the yen, I watch yen futures. They're a rat's hair away from a major monthly close that could break them out to the upside. And so, and I'm seeing some positive things out of the Canadian dollar, for example, which is commodity related. So I think looking at the dollar index as your barometer is to some extent a mistaken stance.
Sure. So I guess how does the euro look then to you relative to the dollar? Draghi's playing this game, and
I can
the big
see
question
the euro,
is
if it can muster its strength up again. It's now 110, 111 area, going up to 115 to 120. That's about as far as I can see it going. But I can see that much. Now, we got 117 back a few months ago when the S&P collapsed. The euro spiked to 117 and quickly backed off. So that's not uncharted territory. So going back there again, I could see in a more slow, methodical manner, and even maybe going to 120, where I think formidable resistance would occur. But from the current levels, that would inflict quite a bit of pain on the dollar index, especially if that were accompanied by strength in the yen. So it's about the worst I could see. Go ahead.
No, you go ahead.
The dollar index has been hovering. The low for the year has been about 93 and just below. The high was just above 100. And we're now sort of in the middle of that range. I think if you go back to 93 one more time, you're not going to hold it. Actually, the low was like 92.80 something. But if you get back to 93, and we got to 93.80 something a few weeks ago, if you go back to 93 again, I think they can get it into the mid to upper 80s from the dollar index, and that would be a shock for a lot of Forex people who don't think the dollar could get that weak. And I suspect if you ever saw the dollar do that, you could then circle the high at 100 that we made in March and say that was it. That was the high of this dollar rally.
Oh. Well, it's all very interesting, and I could see where, some, if you're right, and we're about ready to see some strength in some of the commodities where that could also play a role in the overall currencies. And interestingly enough, Michael, thanks for bringing us up this notion of negative interest rates, because we do have to go to a commercial break now, but when we come back, that's going to be one of the topics we talked to John Rubino about, Michael, because I think it makes, clearly there's some talk about it, and some countries are doing it, and it just doesn't make any sense to me as an old-timer. I don't know about you.
No, it makes no sense to me, but then, it's been Twilight Zone now for several years, so
yes.
We're still in the Twilight Zone. Enjoy.
Yes, we are in the Twilight Zone, I guess, and but it hurts some people, it helps some, and it hurts others, and what we should do is just have free markets and let the markets and let the people decide collectively what they want to do, rather than having a few guys in the Politburo dictate our lives.
That's
But
correct.
anyway, I know
All
you
of
and I are in
your-
agreement on that.
That's right.
Well, thank you, Michael, very much again for being with us. Always great to hear your views on these things. They're views that are based on a lot of good hard work that you do and work that is proprietary in nature. So people should check out Michael's work at olivermsa.com, olivermsa.com. Thanks, Michael, and we'll look forward to talking to you again sometime in
It's
the near
always
future.
good to be on your show, Jay. Thank you.